Welcome to part 2 of the adjustment of single options. So in this part, we're going to look at Amazon. And in this chapter, we're going to look at both the long call as well as the short call. So the long call is a bullish strategy. So let's go pick out an option. And we want to buy a call option. When we buy a call option, we bullish on the stock. And let's say now, Amazon's trading at around $227. And let's say we were bullish. We wanted to optimize a move to perhaps, say, 240 or 250. So what we do is, let's pick the 240 call and we would buy one contract or 10 contracts, whatever the case may be. So here we have 10 contracts of the Amazon July series at the strike price of 240. It's a call option, so we're bullish. And we're going to pay $7.10 per share for this position. And our buying power is going to get reduced by $7,100. So if we look at the risk profile, we see it's of a long call. Our strike price is at 240. And we expect Amazon to go up. We have unlimited profits if it goes up. And if it goes down, our losses are capped at $7,100. Let's now assume that instead of going up, Amazon actually starts to go down. So let's see what happens if Amazon goes down by $10. So here it is, it's at 227 and we're saying it's going to go down by about $10, so about 217 or perhaps even 210. Well, 210 might be too drastic a point, but let's say it goes down to 220. So at 220, you can see that we have a loss of $2,600. You can see that on the white graph and the white number. So even if Amazon goes down by $7 down to 220, you're facing a loss of $2,600 on this position. So perhaps this is a very intense position, and you can see that the delta is 370. So if it goes down by about $7, then 370 into 7 would be approximately, $2,600. That's what this is showing you. So at $2,600, that would be your loss. So always look at delta. First of all, whenever you put a position, always look at delta, because that is your directional risk. And you need to make a decision whether you can stomach that kind of a delta risk or that kind of a directional risk. So in our case, I just noticed that this is a pretty intense position. So I'm going to change this number of contracts to 5. And so now the graph changes again. Our delta gets cut in half. And if it goes down by $7 to 220, now we are looking at a loss of about $1,300, which is exactly half. So now this is something I can live with. So what we need to first of all decide is our pain point. And I've spoken about the pain point a couple of times. So in this case, our pain point, let's say it's at 220. So when Amazon comes down to 220, we need to understand that first of all, we need to adjust. And secondly, what kind of an adjustment we have to make. Now, perhaps you might say that, okay, this is, I'm only giving only $7 wiggle room here, and that's too less. I want to be able to give at least $10 to $12, and that's a very valid outlook to have. In that case, what you would do is change the contracts down to even less. So now if it goes down $10 to 216, you're only facing a loss of 1060 or 1060. So maybe this is a good pain point for you. As an individual trader, as an individual investor, you have to decide what your individual situation is, because everybody has different account sizes, different perspectives, and different risk tolerance levels. Let's say we said that our pain point is right here at minus 5%. So you can see the 216, and that's the minus 5%. At that point, our loss is $1,048. So at this point, we have to now adjust. And when we adjust, we have to think of whether our outlook is changed. First of all, okay, so you were bullish when you got into the trade. Has that outlook changed? Have you become bearish now? If you've become bearish, then you need to turn this trade around, because now you have a positive delta and you need to turn it into a negative delta, because now you want to make money as Amazon goes down. if your outlook is not changed, then what you want to do is to stop the bleeding. The way you stop the bleeding is you look at your delta number and you need to do something to your position so that this delta value comes close to zero. Because then if you have a delta neutral position, it doesn't matter if the stock goes up or down, you're at least stopping the bleeding. And you might ask, what is the point in having a delta neutral position? You're not going to make or lose money. And that's true. But by converting it into a delta neutral position, you're giving yourself some time. Maybe the next 2 or 3 or 4 days will give you a more clearer picture as to what Amazon is going to do. Is it going to continue to go down? Or is it going to turn around? And perhaps within those 3 or 4 days, you can then make your decision as to how you want to go. So at this point, you're bleeding, you want to stop the bleeding. So that's the other way to look at it. So there are 2 ways to look at the adjustment. One is whether your outlook has changed completely, in which case you need to change your position altogether, or you just want to stop the bleeding and review the situation in about 2 or 3 days and then make your decision. So those are the 2 things you can do. Now, in adjustments, unfortunately, with the single options, we are going to have to get into spreads because an adjustment basically involves adding another option. So I know we've not gotten into the spread section, but if you've seen the Goldman Sachs course, we had a bad trade there and Goldman Sachs is going down. Now it's already gone down quite a bit and we had to add another option to that position. And we might still have to do that. That position is still live. Now, in this case, if you're just looking at this long call and if Amazon's going down, then what we can do is to neutralize the delta, we can add a put to this position. And what kind of a put will you add? You'll add a put that somewhat reflects or neutralizes this delta figure. So let's say, simplistically speaking, we've bought the 240 call, we have a delta of 111, then we come here and we look at what kind of a put will give me approximately 111 deltas. And we know that our 240 call has a delta of 0.37. So it's got a 37 delta. So you'll come on the put side and look for a similar delta. So if you come to the put side, you have this 220 put, which has a 37 delta negative. So once then we add that put option, obviously you want to choose the same number of contracts. You can see now that your delta has been neutralized. So once you neutralize your delta, if you go to your risk profile, you'll see that your position has become flat. So the white line has become flat. Now this position is actually called a strangle, but I don't want to confuse you right now. What you've done is you've neutralized your delta. So now when delta, Amazon can go this way or this way, and you'll get your time to see in the next 2, 3 or 4 days, whatever the case might be, to decide what you want to do. Whether you want to maintain your bullish outlook, in which case you'll keep your call option, or if you think Amazon's changed directions and your outlook is changed, then you'll get rid of your call options and let your puts make money. So this is one good way of neutralizing your long call. And the only thing is now you're adding another long option. So you're an option buyer and you're an option buyer of 2 different options now. So your theta decay is going to get more. Your delta is neutralized, which is the most important thing. So think of it that way. Your delta is your primary driver of your profit and loss. So if you want to neutralize delta, this is what you would do. You could also do another thing, and let me show you that. So let me take off this put option over here. And you could do something else too. You won't be able to completely neutralize your delta, but perhaps you can reduce the impact of your delta. So what we can do now is, again, it'll involve creating a spread. And so since we bought the 240 call option, that's what we have right here. And this is the call option that's hurting right now. And so to neutralize that, to some extent, what we'll do is we'll sell, and let me change that to 3. We'll sell the one option above it. And what we're going to do is we're going to get a credit. So we'll get about $5.35. Now this value might change because the option prices would have moved, all of that. But I'm just explaining the concept here. So we sold 3 of these. You've converted this into a spread. It's become a bull call spread, and you're going to learn about that in the next course. But that's how we would adjust this. Now see what happens to your delta. It came down from 118 to 18. So like I said, it's not completely neutralized because its delta is much less than the one that you bought. So the 240 call has a 37 delta. The 245 call has a 31 delta. So it's obviously not going to get completely neutralized. But what it does for your position is it brings your delta exposure down to about $18. So for every $1 move Amazon makes to the downside, your position is now going to lose only $18. But let's look at the risk profile of this. And what you'll see is it's a bull call spread. So again, you're maintaining your bullish outlook. So here you've not changed your outlook. If you look at the white line, it is still bullish because it's going from the left to the right and it's going from the bottom to the top. So that is a bullish spread. But what you've done is you've neutralized delta to some extent and you've stopped the bleeding because now you're going to bleed only $18 for every $1 move that Amazon makes to the downside. So this is how, these are the 2 most popular adjustments you can make to a long call. So if your long call it's a bullish strategy, it's not working out, the stock is going against you, then what you can do is you can either buy a put, and if you buy a put, you have the advantage of waiting for 2 or 3 days and looking at the direction, and if you think Amazon is going to continue to go down, then you just get rid of your call. Of course, you're going to book your loss on the call. Remember that. So whenever you do these kind of adjustments, there's a certain loss that you're going to book. But now your long put has the option to make that money, to recover that money. And whenever a trade goes against you, it's always a good way of thinking about it is let me at least try to get my money back. So your long put will make money hopefully, and you can recover at least some of your losses. You can at least try to come back to break even. And in some cases, you should be able to do better than that as well. But if your outlook is not changed, if you still think Amazon is going to go up, then what you do is you sell a call with a strike price that is above your long call. So your long call is at 240, you'll sell a call that is higher than that. So it will be at 245 or 250, whatever, and you'll get credit for that, and that will blunt your losses to a great extent. So that's how we would adjust a long call position. Let's say your outlook has changed, okay? So Amazon's going down, but your outlook has changed now. Amazon's become bearish because there's some major market news that is sending all stocks down, or something very specific about Amazon, but your outlook has changed. So now what can we do? Then what you need to do is more of a drastic adjustment. So what you would do is you have a delta of 111. Now perhaps what you want is a negative delta of 100. Okay, so now this position, you've already had a loss of about $1,000, but now your position has changed completely. So in that case, you would again go to your put, and perhaps you can even go to an in-the-money put at this time, because in-the-money puts, remember, have higher deltas. So let's say we go to the 240 put, and instead of buying obviously 10, let's say if we just bought 3, what happens to our position? So that makes it a 75 negative delta now. So let's see what that does to our risk profile. So it becomes, now you start making money much more quicker on the downside. So if Amazon continues to go down, so perhaps you want now a 100 delta to the negative. So you can think about what kind of delta you want, because that's a good way of looking at adjustments. Do you want to get to delta neutral, or do you want a negative 100 delta? So if you wanted a negative 100 delta, perhaps you should buy 4 of these put options, and what you have is now a negative 137 delta. So if your outlook has changed, you need to convert your positive deltas into a negative delta, and then you'll start making money as Amazon continues to go down. But if you just want to get to delta neutral, then you would match out the deltas and bring it to delta neutral. But if you're still bullish, if you think Amazon's going to turn around and go back up, then you sell the call option at a higher strike price, and that way at least you're stopping the bleeding at that point, and your delta exposure is very minimal. So that's how you would adjust the long call position.